Buying your first house, and especially getting your first mortgage, can be really complicated. We are going to break down some of the more general rules to a mortgage and how you could save in the long term by staying educated. So, what's a mortgage? Well, a mortgage is a loan to buy a house. Usually, it's about 25 to 30 years to pay off your whole loan, and it takes a certain amount of money up front plus monthly payments to pay off the difference. How much can you qualify for? A good way to calculate this is your income times 4 plus your down payment. And that's how big of a house you could get. This isn't perfect. Now, again, talk to your lender and your mortgage broker. And before you do, have your taxes and income documents in order. Now, they may ask for some other stuff, but they're the experts. They can give you some good information. So let's say you wanted to buy a house again for $500,000. You're going to put down, on average, 20%. So about 100,000, and then you're going to get a loan for the other 400,000. Because a house is such an expensive purchase, a lot of times we can't buy the whole thing up front, which is why we need one. Let's talk about the terms and conditions. How long does it take until it's paid off? It can be 10, 15, 25, 30 years. So if we look at this, 15 years is about 2,200, 25 years is about 1,300, and 30 years is about 1,100. Now, the longer loans doesn't always mean it's a better option. The reason for that is interest. Now, interest is how the banks or the lenders get rich. This can be considered a fee for the loan. It could be their risk protection in case something goes wrong. But at the end of the day, it's the profit that the banks or the lenders make. Your interest rate is everything. It is extremely important to know and to be very deliberate when you're going to get your interest rate, because it makes a very big difference on how much you're going to pay every month. Let's say we go back to our $500,000 house. We put $100,000 down and we get a loan for $400,000. A 0% interest is $1,100 a month. A 4% interest is $1,900 a month. And a 10% interest is $3,500 a month. Now, the principal is how much is going towards the loan, and the interest is how much is going to the bank for profit. Again, 0% means 0 is going to the bank. 4% means $1,300 is going to the bank, and only $500 is going to pay off your loan. Now at 10%, we're at $3,500 a month. Look at this. Your first 12 months, you're spending about $100 to pay off the loan. After a whole year, you've paid off almost $3,000, okay? And you've spent thousands. Over 30, almost 40,000. This is a little breakdown to understand how interest is calculated. There's the prime and the overnight. So you're going to go to the bank and ask for a number, and they're going to give you what it's going to cost to get the loan. Now, the banks don't have the money either. They need to go to the central bank, which is the Bank of Canada, and they need to ask them for the loan. So the Bank of Canada is going to say, okay, we might charge you 2%. And then the bank says, okay, we'll charge you another 2%. For us, it'll be 4%. The bank will get it for 2%. And, the Bank of Canada, well, they're the ones that issue the loan. So they kind of make that decision. Interest, of course, is not that simple. It changes. So it's not always fixed, but there's different terms that you can get when it comes to a mortgage. So you can get a fixed rate or a variable rate. A fixed rate just means when you're signing the contract, you may agree with the bank that it's going to be 4% and it's going to be 4% for the entire 30 years. You could get a variable rate. So you could say, hey, today it's 4%, but next month the Bank of Canada might lower the rate. They may lower it to 3.5. So then my rate's going to be 3.5. Variable means it changes with time. Every month or every couple months, it may go up, it may go down, or it can stay unchanged. Or you could get a fixed rate and that stays the same for your 30 years. There's one other thing that you need to consider. Even if you have a fixed rate, you may be forced to renew the rate every 3, 5, or 10 years. And this is also going to be based on the type of mortgage, the type of contract that you sign. Again, going back to why you want to use an expert. Let's look at this final example. We're going to put everything together here. Let's say you buy a house for $500,000. You need 30 years to pay it off, and you're going to renew your rate every 5 years. You're going to put $100,000 down, so you only need to pay $400,000 out of your $500,000 loan. And let's say you get a 4% interest. Like we said, it'll cost you $1,900 a month, But that 4% interest is going to bring $287,000 of profit to the bank or the lender. Interest is everything. It makes such a difference, and you pay a lot of the interest at the start, and then you pay your principal later down the line. So just know the banks are always going to get their money. On this loan, right, you only owed the bank $400,000. But if you stick out this 30-year term, you're going to end up paying them $687,000. It's going to be way more just because you got a 4% interest rate. The way that you're going to be great is by staying educated, understanding your interest rates, understanding the rules and the terms, using an expert, and having them negotiate and shop around. Different banks can offer different rates. Understanding that having that mortgage broker, they're going to shop around on your behalf and find the bank that can bring the best loan for you. All additional contributions make a big difference in the end. The key thing that you need to understand here is that, let's say we use our example again of a 4% interest rate. It's going to be $1,900 a month, and that's what we have to pay every month. $1,300 goes towards the bank, and $500 goes towards our loan. Every extra dollar that's contributed after our fixed mortgage amount goes straight to principal. And this is how you could pay your house off way faster, and how bi-weekly payments makes a difference. Because let's say we added another $1,000, so we put $2,900, right, instead of $1,900. The first $1,900 is going to go to our usual split here. But our extra $1,000 that we're contributing that month is going straight to the principal. So there's no interest. And this is how you can end up paying your house off way, way faster. Now, there are limits to this. Again, always talk to your mortgage broker. Talk to your experts. They will make all the difference and will save you a ton of money in the end. I am not a financial advisor. I've made and lost thousands of dollars in multiple industries, including real estate, and I am always open for questions in my free Discord. I hope you have a wonderful day, and congratulations on looking for your first house.